What's up, everyone? It's Scotty with MoneyVest. So wanted to give you a little bit of a round out in the markets right now with where we are. The market just hit its 30th new all-time high, the S&P 500 yesterday, with a very strong rally in the NASDAQ. Of course, Tesla up over 5%. Nvidia continues to hit a new all-time high. And I also wanted to break down the market's technical positioning with where we were 3 weeks ago and with where we are today. There's been some very interesting shifts in the market, which I want to highlight, and hope you all enjoy this video. And of course, find it helpful. If you do, please make sure that you drop a like and subscribe to the channel if you're just joining us for the first time. And links to our Discord and Patreon is going to be down below if you're interested in joining us. And we'd love to have you on board. There is a 51% discount for the MoneyVest beta launch, and a lot of our research, eventually it's going to make its way over to the platform. Right now, this is what it looks like. You can pretty much access the MoneyVest metrics, the fundamental analysis on individual stocks broken down by income statement, balance sheet, cash flows, the ratios section, as well as the analyst estimates for individual stocks as well. You can take a look at the consensus EPS and revenue expectations for each and every company. And of course, our discounted cash flow and our discounted earnings multiple model also included, with right now this pricing being over a huge discount. You can lock this in for life. So links going to be down below. We'd love to have you on board. So first things first, let's quickly break down exactly where we were 3 weeks ago. And there's been some very interesting shifts in the overall market, technically speaking. And this was a video that I did about 3 weeks ago talking about where we are within the market for the S&P 500 and of course for Magnificent 7 as well. And what you'll notice is that back in 3 weeks ago, the S&P 500, which has of course 503 companies in the overall index, basically has over 500 companies within the index, over 60 RSI, right? So for companies that had a RSI reading of over 60 was 157, so 31%. So about a third of the market had an RSI reading, which is a relative strength index, a very good technical indicator of over 60. If you fast forward to where we are now, and consider this, the markets are at a new all-time high. The markets are at a new all-time high. From 3 weeks ago, we've also obviously pushed higher. And you think, right? Think what? If I ask you to pause this video and simply answer me this question, markets are at an all-time high. From 3 weeks ago, we have obviously rallied quite a bit. So if 3 weeks ago, the number of stocks that were trading above their 60 RSI were 157, what would you say is that number today? Would you guess higher or lower? And if you pause this video, I'm assuming most people are going to guess that now this number is higher, because guess what? Markets are higher. Markets are hitting a new all-time high. So it's, ideal. It's a more rational thing to assume that more stocks are trading above their 60 RSI reading. Well, guess what? We are at 90. We are at 90, folks. We are at 90, 90. And that number has come down significantly. It's pretty much been cut in half. So we've gone from a 31% reading down to 17%. So there's been about a 40-45% correction in this particular metric. That just simply goes to show that more stocks have fallen below the 60 RSI reading here, and yet the markets are at an all-time high. That makes you wonder. This right here is also dropped below. So in terms of the 50 RSI, how many stocks are trading above their 50 RSI? Pretty much 60% of the market 3 weeks ago was trading above the 50 RSI reading. That was 306 companies. Now we've got 208 companies. So over 100 companies here have now fallen back below the 50 RSI reading, and only 41% of the market right now is trading above it's 50 RSI at the moment. If you come over to stocks trading above their 200 simple moving average, 3 weeks ago, this number was 386. In other words, 76%, so 3/4 of the market was trading above its 200 simple moving average. Well, that number has now dropped down to 65%, or only 330 companies that are now trading above their 200 simple moving average. When it comes to 50 SMA, that number was back at 290, or 57%. And now we're looking at 45% down to 227, and 52-week high and 50-day highs. In other words, how many stocks are within 10% of their 52-week highs? Back 3 weeks ago, 295, so just under 300 companies, or 58%. And when it comes to 50-day highs, how many companies, how many stocks in the S&P 500 are within 10% of their 50-day high? That was at 369, a very, very high number of 73%. And both of these numbers have also come down to 42% and 61% respectively. So logically speaking, this gives me a very good perspective on the technicals of the market, and that simply says what? This. Majority of the market has pulled back a little bit back below its 50 RSI, 200 SMA, 50 SMA. It's not really within the 10% range of its 52-week highs or 50-day highs anymore. From 3 weeks ago, we have seen pullbacks and somewhat of a slight dip in other parts of the market. And the fact that we've seen the markets rip to new all-time highs is once again on the back of just a few companies, and that's exactly what I'm here to show you. And this is where all the liquidity has gone to, where if you come down, a lot of the weights for the Magnificent Seven have gone up, and the RSI readings for these three companies, more specifically Apple, Microsoft, and Nvidia, have also gone to crazy levels from 64, 69, 64 to now sitting at 72, 78, and 78. And the weightage has also gone up 7.2%, 6.8%, and over 7% of the S&P 500. So again, very, very substantial increases in all these companies. Apple, of course, having a full 1 percentage point increase in its influence in the S&P 500. Nvidia, of course, having a 2 percentage point increase from just a 3 weeks ago period. It's gone from 5.1% weight to over 7% now. And of course, the RSI reading for these three companies also increasing. So really, the bottom line is the markets are being propped up right now at a new all-time high on the back of these three companies where the concentration is very, very high. In fact, it's so high that I'll show you some relative charts that are now showing some very troublesome or worrisome indicators that I want to address in this video as well. So really, it's other parts of the market that have seen a bit of a pullback from 3 weeks ago. There's been some dips, and again, majority of stocks have started to roll over, except for these 7 companies, and more specifically these 3 companies that are now again making up for well over 20% of the entire S&P 500. So less than what did we talk about? Less than 1% of the companies are now making up for over 20% of the entire S&P 500, and less than 2% of the S&P 500 makes up for over 30% of the S&P 500. Definitely worth considering where we are in this market concentration. Now, this right here is also some very interesting charts. Shout out to Charlie Belio for putting this together on Twitter. So this first chart goes over the ratio of large caps to small caps. And this is once again the highest level we've seen since April of 2000. So in over 24 years, this is the highest differential we've seen, or in other words, the outperformance we've seen for large caps relative to US small caps. And of course, we already know what happened back in 2000. The entire market came crashing down. Not saying that the same event is likely, but just something to consider, because I feel like this time around, the markets are, of course, backed by strong fundamentals and strong revenues and cash flows and earnings for these companies. But it just begs the question, how much higher? How much higher does this market really have to go here, considering that this has been an absolutely stellar rally? Everything's been ripping higher to new all-time highs, most specifically semiconductors and technology. And again, the 3 and 4 companies that I mentioned in the previous slides. So this right here, highest level since April of 2000. This right here also hitting its highest level since April of 2000. So large cap growth versus large cap value. And this is exactly, you'll notice in the last 3 weeks, this really has gone parabolic a little bit further. And that just goes to show that, again, growth outperforming value. Growth, that's where concentration, that's where liquidity and everything is going to. And value is starting to see some stabilization, some consolidation, or even a pullback. And as a result, its highest level since July of 2000. Also for this particular chart. This right here is US stocks versus international stocks. And once again, you'll notice a 16 years worth of outperformance from the US companies. Absolutely massive increase in the overall price here. And this right here is going to be semiconductor ETF versus S&P 500. And we are back to where we were back in June of 2000 in terms of this massive outperformance that we have witnessed for semiconductors relative to the S&P 500. So this ratio coming down to now under 0.5, and just a huge amount of increase in the influx of capital for, of course, Nvidia, for Broadcom, for Supermicro, for a lot of companies in the semiconductor sector here. Now, this right here is the S&P 500 closing, of course, to a new all-time high for the 30th time since 1929, and also having the best start to the year in an election year in history. And this is exactly what we have talked about in our previous videos as well, that the probability for the markets to close green is about 100%, because every single time the market since 1930s has seen the first 116 trading days when it's up over 14-15%, it has closed green. So there's no doubt about it that in the next 6 months, based on statistics, based on history, the market is going to close green. We obviously don't know how much green, how much higher does this market rally really have, but of course 3 or 4, actually 5-6 times out of the last 20 times the markets have pulled back. So the probability for us to see the second half of the year also push higher is about 75%, but for the entire year to close green is about 100%. So there's, again, no doubt in our minds, in my mind, that the markets are most likely going to close very strongly, for the entire year. But how much higher? That's still under question. And this right here, again, is a chart of going over the 3 largest companies in the world, which are, of course, your Microsoft, Apple, and Nvidia, all trading well over $3.2, $3.3 trillion. And the entire market cap of Russell 2000 is $3 trillion. That is absolutely a wild statistic. If you combine the market cap of all 2,000 companies in the Russell 2000, it's $3 trillion, and the market cap of the 3 largest companies is sitting at well over $9 trillion, almost $10 trillion, 3 times as more as the Russell 2000. And one more thing I want to go over is the Vanguard's expectations for future growth here. So what they did was they basically compiled together a return expectation for the next decade, for the next 10 years with some median volatility. And they're expecting U.S. equities to only give us somewhere between 3.3 and 5.3%. So that, of course, is a very, very low rate of return, primarily because of the markets that have already ripped so high. And your future returns are always determined by prices, right? The prices that you pay today determines your future returns. So if prices are higher today, your future return expectations are going to be lower. If prices are really low today, if they're cheaper, then of course your expectations for rate of return is going to be much higher. And I think that's really what they're doing here, with value being somewhat undervalued according to them. They're expecting a much higher rate of return, and U.S. growth to only give us a 0.4 to 2.4% rate of return. This is annualized basis, and large cap to give us 3.1 to 5.1%. With small caps with a much higher rate of return, real estate with a much higher rate of return, global equities, or in other words, emerging markets and international markets, to be much higher at 6.7 and 8.7%, which I do somewhat agree with, because I do think that India has a ton of potential over the next decade. Most likely is going to somewhat outperform the U.S. counterparts, but again, they have released this analysis multiple times in the past, so there is some silver lining here, because in the past also they've expected U.S. equities to not perform as well, and here we are, the market's hitting a 30th new all-time high, pushing higher, just absolutely ripping. And this right here is going to be for fixed income, so for bonds, and they're expecting U.S. aggregate bonds and U.S. Treasury bonds to weigh somewhere between 4 and 5%, with a lot less in terms of volatility. So on a volatility basis, on a risk-adjusted basis, they're actually expecting for fixed income to do better than equities. Again, of course, time will tell us, right? So we'll find out eventually. So the bottom line is the markets are continuing to get more and more concentrated among the top 3 and the top 5 names. There's a lot of liquidity flooding out of other value stocks, other fixed income, derivatives and instruments, and of course pushing over to equities, and more specifically the top 3, top 5 here. So caution, of course, is advised. Something that I think we have mentioned before is that I think it's really important to be careful, be understanding of the fact that this is not going to go on forever, and eventually there's going to be a time where we do start to see some profit taking, some money moving out of these top 3, top 5 companies, and that's exactly when the opportunity will present itself again. This is going to be an opportunity because the markets do pull back, and that when they do, that's a buying opportunity for us. So hope you all enjoyed this video and found it helpful. If you did, make sure that you drop a like, subscribe to the channel if you haven't already. Again, links to our Discord and Patreon is going to be down below. Happy investing. I'll see you all in the next video.